Hi, Tim Biggam back again this week for Traders Exclusive, and what a beginning to the week we have seen. Certainly we've had the biggest pounding that the market really has taken pretty much all year, following news out of Syria. We had obviously some weak economic data coming out of China. India's currency getting absolutely slammed, some old problems erupting in Greece. Italy starting to feel a little bit of that tension as well, bleeding through there. Portugal, some bad news out of there. So, the sell-off that we saw has been staunch over the past couple days, retraced about half of that loss. And I really look for kind of, as I alluded to the past couple shows, just kind of a Deadsville range-bound market here. Again, 1,700 or so to the upside in the S&P 500. 1550 to the downside. Looking at some names like Google, that stock has fallen down now to a fairly attractive range. I'm actually looking to be a buyer on about a 7% pullback, positioning by selling out of the money put spread out in October, selling the 805 puts, buying the 800s for protection, collecting about 75 cents. So, looking for Google to, remain somewhere around that 850 level, certainly not getting decimated, too much from here. I do have about a 7% cushion and, looking to make, somewhere around a 12% net return on that trade. Another stock I'm looking to do that in is Apple as well. I'm looking at tech here as kind of almost a safe haven to any kind of, world kind of events. Certainly any slowdown won't be fed as much by the tech stocks. So looking at Apple, that 460 level, buying the 455 puts again out in October with a similar kind of credit. So I like selling that 5-point spread, collecting about 70 to 75 cents. That tends to usually be about one standard deviation out of the money, which the market being leptokurtic, which is a fancy way of saying that it either stays right here or if it does move, it moves big. That area in between tends to be overpriced for the actual events taking place there. So I like to position usually about one standard deviation out of the money using either the VIX for the S&P 500 or the individual stock to position there. And usually that equates to about a 70 to 75 cent credit on a 5-point spread. So that's the area I like to play in. On another note, we are entering the turn of the month, which I've gone back, done a lot of research since 1990. The turn of the month, which is the last 3 trading days of this month and then the subsequent first 3 trading days of the next month. So in this case, the last 3 trading days in August, first 3 trading days in September. But if you take a look, those 6 trading days since January of 1990 have accounted for slightly over 100% of the gain in the S&P 500. So if you've just been in the market those 6 days, you've captured slightly more than all of the gain in the S&P 500. Meanwhile, reducing your risk obviously to about 25% roughly of the time. So you're getting 101% of the gains as of today, while only being in the market 25% of the time. Obviously, the rest of the time you could have invested in a yield-bearing instrument. Up until recently, that made a lot of sense. But with interest rates here, it's kind of no harm, no foul. So just an interesting note there that we are entering into a calendar-based, very bullish period over the next 6, or in this case 5, because we've already had 1 trading day or so. So until next week, this is Tim Biggam. As always, keep those position sizes in place and your risk accordingly. Take care.